The 2026 stock market crash no one is warning you about. The stock market is hitting all-time highs, and let's be honest, most investors are feeling pretty much invincible. But what if I told you that some of the biggest retirement account losses don't happen during a crash? They happen in the months right before it, when everything on the surface looks perfect. There's a subtle pattern in the market, one that has repeated itself for the last 100 years. And right now, the quiet moves of the world's most sophisticated investors are signaling that this pattern might be unfolding all over again. What they're doing in secret reveals a truth that very few on Wall Street are talking about. The risk of a major downturn in 2026 isn't just a possibility. It's a scenario worth taking very seriously. We are living in what feels like an age of unshakable confidence. You've got major banks like JP Morgan forecasting double-digit gains for equities in 2026, largely fueled by an AI-driven supercycle. It's a story of fantastic earnings and unstoppable growth. But if you look just beneath that shiny surface, a very different story is taking shape. While many analysts are bullish, they also admit there are big risks on the horizon. Morningstar, for instance, has pointed to dangers like the extreme concentration in a few mega-cap tech stocks and the fact that a slowing labor market or sticky inflation could disrupt the rally. This isn't about spreading fear, it's about seeing the whole picture. Because a century of market history has shown that the moments when everyone is the most confident are often the most dangerous. I went back and analyzed the anatomy of every major market top since the 1920s, and a three-stage cycle appears again and again. The evidence I'm seeing suggests we may be in the final, most critical stage of this cycle right now. Stay with me because the pattern I'm about to show you could not only help protect your wealth, but position you for the opportunities that always follow a storm. The three-stage pattern of every major crash. To really get what's happening now, we have to look back. Major market tops are rarely random events. They often follow a predictable script, a psychological drama that unfolds in 3 acts. This isn't some fringe theory. It's an observation based on how human emotions, especially greed and fear, interact with money on a massive scale. Act 1 is euphoria and speculation. This is the party. The market is roaring and it feels like the old rules just don't apply anymore. Think about the roaring 20s. Before the 1929 crash, there was this widespread belief that a new era of permanent prosperity had arrived. People were borrowing huge sums of money to buy stocks on margin. We saw the same story play out in the dot-com bubble of the late 90s. Investors threw cash at internet companies with zero earnings, totally convinced that old-school metrics were obsolete. In both cases, valuations became completely detached from reality, all propped up by a seductive story of revolutionary change. Today, you hear echoes of that, with some pointing to historically elevated valuations and frothy conditions as a reason to be cautious. Yes, Act 2 is the smart money distribution. This is the crucial, often hidden phase. While the public is still popping champagne, the most sophisticated investors, the insiders, the billionaires, the smart money, quietly start to sell. They don't make a big announcement. They don't go on TV to warn everybody. They do it slowly, methodically, offloading their overvalued assets to the euphoric masses who are happy to buy. They aren't trying to time the exact peak. They're simply reducing their risk while the market is still strong and there are plenty of buyers. This is the stage where wealth is subtly transferred from the uninformed to the informed, right before the music stops. Act 3 is the crack and the cascade. This is the crash itself. It often starts with a single trigger, an unexpected corporate bankruptcy, a geopolitical shock, or a sudden freeze in the credit markets. But the trigger isn't the real cause. It's just the pin that pops a bubble that's been swelling for months or even years. The first drop creates panic. The very same leverage that supercharged the climb up now accelerates the fall. Margin calls force people to sell, which pushes prices down even further, triggering even more margin calls. It becomes a vicious, self-feeding downward spiral. After the 1929 crash, the market collapsed for years. The dot-com bust wiped out a massive chunk of the Nasdaq's value over 2 years. The 2008 financial crisis was a similar story of one failure cascading into the next. This 3-act structure is a compelling pattern we've seen in many major downturns. But of course, not all crashes fit this mold perfectly. Some, like in 1987 or 2020, were driven by sharp, sudden shocks. The question is, where are we now? The evidence I'm about to lay out suggests we've been in Act 2 for a while, and the first tremors of Act 3 may be starting. The warning signs from the smart money. So, what are the modern-day clues that the smart money is getting nervous? Let's look at 3 key indicators that are flashing. If not red, then a very deep yellow. First, let's follow the ultimate insider, Warren Buffett. Buffett has a legendary track record of being cautious when others are greedy. He famously sat out the dot-com bubble only to be proven right when it all came crashing down. So, what's he doing today? His company, Berkshire Hathaway, has been stockpiling an enormous amount of cash. While headlines can be confusing, with some citing figures over $300 billion, which often include other assets, what's clear from financial filings is that Berkshire's holdings in cash and short-term T-bills are at or near record levels, with some public sources putting the figure well into the hundreds of billions. Why would one of the greatest investors in history choose to hold so much cash, which earns a relatively modest return, instead of buying more stocks? Buffett himself has said he's struggling to find attractively priced businesses in this market. This massive cash pile is dry powder, capital that's ready to be deployed when assets get cheaper. It's a defensive move that speaks louder than any market forecast. He's getting ready to buy when everyone else is forced to sell. Second, let's look at corporate insiders as a whole, the CEOs, CFOs, and directors of public companies. Those people understand their own business prospects better than any Wall Street analyst. And right now, their buying and selling activity is telling a clear story. The insider buy-sell ratio tracks how many shares insiders are buying versus how many they're selling. As of late 2025, data shows that insiders are selling far more shares than they are buying, with the ratio hovering around 0.28. This means for every 1 share an insider bought, nearly 4 were sold. This is a clear signal that the people with the most intimate knowledge of their companies are, on the whole, taking profits off the table and reducing their exposure. Third, let's look at one of the most reliable valuation tools we have, the Shiller P/E ratio, also known as the CAPE ratio. This metric smooths out earnings over a 10-year cycle to give us a clearer picture of whether the market is cheap or expensive compared to its own history. As of early 2026, the Shiller P/E ratio is at a very high level, hovering in the high 30s to around 40. To put that in perspective, its long-term historical average is closer to 17. A valuation this high has only been seen a couple of times in modern history, at the absolute peak of the dot-com bubble and during the post-pandemic rally in 2021. Now, some will argue that today's high valuations are justified because of higher profit margins or the amazing promise of AI, and they might have a point to an extent. But a number this far above the historical average is a flashing warning sign. History shows that when the CAPE ratio gets this elevated, the odds of lower than average returns over the next decade go up dramatically. It's a risk gauge, And right now it's telling us that the market's risk level is exceptionally high. If high valuations and insider selling are the kindling, then debt is the gasoline. And right now the corporate world is sitting on a mountain of it, with a fuse that's getting shorter every day. During the decade of near zero interest rates, corporations went on a borrowing frenzy. It was practically free money. Well, that era is over. Now a massive amount of that debt is coming due and has to be refinanced at today's much higher interest rates. This is what analysts call the maturity wall. While estimates vary depending on what you include, some sources suggest U.S. companies are facing a maturity wall of well over $1 trillion for 2025 and 2026 alone. Think about what this means. A company that borrowed money at 2% might now have to refinance at 6% or 7%. That's a massive jump in their interest costs, and that money comes directly out of their profits. For some companies that are heavily in debt, this won't just be a drag on their earnings, it could be an existential threat. And we're already seeing the stress fractures. In 2025, business bankruptcies continue to trend higher, reaching the highest levels since 2010. The number of fallen angels, companies downgraded from investment grade to junk status, is also an area analysts are watching closely for signs of stress in the credit markets. This creates a really fragile situation. As more companies struggle to pay their debts, the risk of defaults goes up. A few high-profile defaults could be the trigger that starts that crack and cascade phase I mentioned earlier. It can lead to a credit crunch, where even healthy companies find it hard to get the capital they need to run their business. This is a key part of what happened in the run-up to 2008. The problem wasn't just subprime mortgages, it was the domino effect that rippled through the entire system when the default started. The combination of record-high valuations, quiet selling by the smart money, and a looming corporate debt bomb creates an environment where the market looks strong on the surface, but the foundations are shakier than many people realize. Now, hearing all of this might feel a little unsettling, but my goal isn't to scare you, it's to prepare you. Recognizing these patterns is the first step to successfully navigating them. The greatest transfers of wealth happen during times of volatility, but only for those who are positioned for it. You'll want to get my ongoing analysis of these trends and the specific strategies I'm looking at to protect and grow capital. I encourage you to subscribe to my free weekly newsletter. I break down what the latest market data really means and share actionable steps you can consider. The link is in the description below. It's totally free, and it's the best way to stay ahead of the curve. So what does this all mean for your money? How do you protect yourself from a potential downturn and maybe even turn it into an opportunity? It's not about panicking and selling everything. It's about being strategic. Here's a simple 3-step framework to think about. Step 1, build your war chest. This is exactly what Warren Buffett is doing. Having cash on hand during a downturn is the single most powerful tool an investor can have. While everyone else is being forced to sell their best assets at fire sale prices, you can be the one buying them at a massive discount. This doesn't mean you should sell all your stocks tomorrow. It means taking an honest look at your portfolio and maybe trimming positions that are highly speculative or have grown too large. Consider taking some profits on your biggest winners and reallocating that into cash or short-term treasuries. The goal is to have a slug of your portfolio, whether it's 10%, 20%, or more, depending on your own comfort with risk, ready to deploy when opportunity knocks. Step 2, stress test your portfolio with a quality filter. In a downturn, not all stocks fall equally. Low-quality, unprofitable companies with tons of debt often get hit the hardest. High-quality companies, on the other hand, the ones with strong balance sheets, consistent profits, and a real competitive advantage, tend to be far more resilient. Go through your portfolio, company by company, and ask yourself the tough questions. Does this company have a mountain of debt? Is it consistently profitable? Would it survive a brutal recession? This is the time to be ruthless. Consider selling the companies that don't pass this test. Your goal is to consolidate your portfolio into businesses that are built to last, not just built to fly high in a bull market. Step 3. Adopt a long-term anti-timing mindset. Trying to time the exact top or bottom of the market is a fool's game. Seriously, even the experts can't do it. The strategy here is not to sell everything today hoping to buy it all back at the bottom. Instead, it's about using a dollar-cost averaging approach, especially if and when the market starts to fall. By investing a fixed amount of money at regular intervals, you automatically buy more shares when prices are low and fewer when they're high. If the market does hit a rough patch in 2026, those who continue to systematically invest their dry powder into high-quality assets will be picking them up at cheaper and cheaper prices. When the market eventually recovers, and it always has, their returns will be magnified. This mindset transforms a market crash from something to fear into a long-term opportunity. The prevailing story in the market right now is one of relentless optimism, with many experts pointing to continued growth in 2026. But as we've seen, there are powerful undercurrents that suggest a much more cautious approach is warranted. Extremely high valuations, significant selling by corporate insiders, and a massive wall of corporate debt are all converging to create a level of risk we haven't seen in years. The historical pattern is pretty clear. Periods of intense euphoria are often followed by a reckoning. The smart money seems to be preparing for that possibility, and it's probably wise for the rest of us to pay attention. This isn't about trying to predict the exact date of a crash. It's about recognizing the signs of a fragile market and taking smart, logical steps to protect yourself. By building up your cash reserves, focusing on high-quality businesses, and keeping a long-term perspective, you can navigate the potential volatility ahead, not with fear, but with confidence. You can be the one who is prepared, the one who is strategic, and the one who comes out of the next cycle stronger than before. Thanks for watching.